Have you noticed something strange happening in the market this week? Oil prices were exploding just days ago. Gas prices were creeping higher across America. Investors were panicking about a major Middle East war. And suddenly everything flipped. Crude oil dipped close to $100 a barrel. The S&P 500 started climbing again. And suddenly people are asking the same question I am asking. Is the danger actually over, or is this just a temporary relief rally? Because when markets move this fast, it usually means investors are reacting to a story that may or may not last. Right now, that story is the possibility of an Iran ceasefire and the reopening of the Strait of Hormuz. But if you are an investor, there is something much deeper happening beneath the headlines. Oil prices, energy stocks, airline stocks, retail companies, and even your index fund are all reacting to the same geopolitical domino effect. And today I want to break down exactly why your portfolio might be green right now, and why the next move in oil could completely change the direction of the market. Before I jump into the explanation, make sure you subscribe to Dave Invests Smart, because on this channel I try to decode the real forces behind financial headlines, so we can understand what is actually happening with our money, instead of reacting emotionally to market noise. Let me start with the single most important location in the global energy system, the Strait of Hormuz. Most people have never heard of it, but this narrow waterway between Iran and Oman is one of the most important economic choke points on the planet. Roughly 20% of the world's oil supply travels through this tiny corridor every single day. So when tensions rise in that region, global markets react immediately. And that is exactly what happened when the conflict between the United States, Israel, and Iran escalated earlier this year. Iran responded by attacking ships and threatening to block the strait, which caused tanker traffic to collapse and sent energy markets into chaos. Oil prices exploded. Some crude benchmarks jumped above $100 per barrel almost overnight. Gas prices across the United States surged because oil prices are one of the biggest factors that influence the cost of gasoline. And when energy prices spike, something predictable happens in the stock market. Stocks fall. That is exactly what investors saw during the early days of the conflict. Global markets dropped as investors feared a prolonged energy shock that could drive inflation higher and slow economic growth. But now something interesting has changed. Recently, the market started reacting to the possibility that the conflict could end sooner than expected. Reports and political statements suggesting a potential ceasefire suddenly triggered a wave of optimism across financial markets. Oil prices quickly dropped from their panic highs and settled around the $100 range. And when oil dropped, the stock market did something very predictable. It rallied. The S&P 500 gained ground as investors interpreted falling oil prices as a signal that the worst-case scenario might not happen. But when I look at these moves, I do not just see a rally. I see a classic relief rally. Let me explain what that means. A relief rally happens when markets have been pricing in a negative scenario like war or recession, and suddenly new information suggests the outcome might not be as bad as feared. Investors rush back into stocks and prices jump quickly. But relief rallies are not always permanent. Sometimes they fade once the market realizes the underlying risk has not actually disappeared. And that is why the Strait of Hormuz still matters so much. Even though markets are celebrating the possibility of peace, the reality is that the waterway remains one of the most fragile energy choke points in the world. Analysts continue to warn that any disruption in the strait could immediately push oil prices back up. Which brings me to the next piece of the puzzle. Gas prices. The national average gasoline price in the United States recently climbed to around $4 per gallon as energy markets reacted to the conflict and the disruption in shipping routes. Higher crude oil prices translate directly into higher gasoline costs because oil is the primary input used to produce fuel. So when oil prices drop, Americans feel relief at the gas pump. And that relief has ripple effects across the entire economy. Think about it from the perspective of an airline company. Fuel is one of the largest operating costs for airlines. When oil prices rise, airline profits get squeezed because jet fuel becomes more expensive. When oil prices fall, the opposite happens. Airlines suddenly become more profitable. That is why airline stocks often rally when energy prices drop. The same logic applies to shipping companies, trucking firms, and logistics providers. Transportation costs fall. Margins improve. Investors get excited. But the ripple effect does not stop there. Lower energy costs also benefit retailers. If gas prices are high, consumers spend more money filling their tanks, which means they have less money available for shopping, eating out, or buying discretionary products. But when gas prices fall, consumers feel richer. They have more disposable income. And that extra spending flows directly into companies like retailers, restaurants, and travel companies. So when oil prices decline, you often see a chain reaction across the stock market. Airlines rally. Retail companies rally. Travel stocks rally. And suddenly the entire consumer economy looks stronger. But there is another group of stocks that reacts in the opposite direction. The so-called war hedge stocks. These are assets that investors buy when geopolitical risk increases. Energy companies are a big example because higher oil prices increase their profits. Defense contractors are another example because military conflicts often increase defense spending. And then there are safe haven assets like gold, which investors buy when global uncertainty rises. During the peak of the Iran conflict, many of these assets surged because investors were preparing for a prolonged crisis. But once the possibility of a ceasefire appeared, something interesting happened. Those war hedge trades started reversing. Energy stocks began cooling off. Defense-related stocks slowed their rally. And investors rotated back into sectors that benefit from economic stability. This shift is one of the clearest signs that the market is currently pricing in a more optimistic scenario. But here is the question I keep asking myself. Is the market getting ahead of reality? Because when I look at geopolitical conflicts historically, they rarely resolve as quickly as markets hope. Even now, analysts warn that the Strait of Hormuz situation remains extremely fragile and could quickly destabilize again, depending on political decisions and military developments. And if that happens, oil could spike again. Remember, nearly 1/5 of the world's oil supply passes through that narrow waterway. If shipping disruptions return, the supply shock could push crude prices far above $100 again. And if oil rises, the entire market narrative flips. Airlines suddenly face higher costs again. Retailers face weaker consumer spending. Inflation fears return. And the Federal Reserve suddenly has a much harder job controlling the economy. That is why energy markets often act like the heartbeat of the global financial system. When oil moves, everything else eventually reacts. Now, from an investor perspective, I think the real lesson here is not about predicting whether oil will rise or fall tomorrow. It is about understanding how interconnected these systems are. One geopolitical conflict in a narrow shipping lane can move the global stock market. It can change the price of gasoline in American cities. It can influence inflation data, interest rates, and even consumer spending. And when you understand those connections, you start seeing the market very differently. Right now, the market is celebrating the possibility that the worst-case scenario in the Middle East may not happen. Oil has cooled. Stocks are rising. Investors feel relieved. But relief is not the same as certainty, which means the next few weeks could be extremely important. If the ceasefire becomes real and energy flows normalize, then oil prices could stabilize and the market rally might continue. But if tensions flare again, the same markets that are celebrating today could reverse very quickly. And that is why I always remind myself that markets do not just react to reality. They react to expectations. Right now, expectations are optimistic. But expectations can change in a single headline. And when they do, the ripple effects move through the entire financial system faster than most people realize. If you found this breakdown useful, subscribe to Dave Invests Smart, because my goal with this channel is simple. I want to help you understand the deeper economic forces behind global events, so you can stay calm and make smarter investment decisions while everyone else is reacting to headlines.